The Nigerian stock market, having done greatly in 2025, is projected to do far much more better in 2026.
Psychology is the biggest part of investing. No matter how much the technicals take, no matter how much the research takes, if your investment psychology is poor, you are 100% guaranteed to lose money in the market.
If I was to begin my investment journey today, what are the first steps I should take?
As a beginner, please consider risk management. If you don't make money, don't lose money.
Based on available data and global projection, the Nigerian stock market, having done greatly in 2025, is projected to do far much more better in 2026. Now, what this means is that the Nigerian stock market is the best place to invest in 2026. Now, we've gotten a lot of questions from people, I and my team. Questions such as, how can I start investing in the stock market? What intentional steps should I take? Now, how can I become a shareholder in one of the world's fastest growing stock market, which is the Nigerian stock market? Yes, this is why today's episode is like this. We have to provide answers to these questions and more. This is Clockwise, and my name is Providence. Today, we'll be discussing investing in the stock market in 2026, even as a beginner. How do you begin investing in the stock market in 2026, even as a beginner? And as usual, I'll not be doing this conversation alone. I have my in-house analyst and stock researcher, someone that has a very deep knowledge on how the market works. With a resounding virtual round of applause, please welcome Mr. Ekane. Welcome to Clockwise again.
Thank you very much for having me. Thank you to the listeners.
The last time you actually dropped some bombshells, people were going through it, and we had a lot of feedback from it. That was a nice one. Now, today's conversation will just be dwelling on how to invest, how to begin this investment journey in Africa, or one of the world's fastest growing stock market in the world, the Nigerian stock market. Now, speak to me as a complete beginner in 2026. If I was to begin my investment journey today, what are the first steps I should take?
Okay, so as someone who is starting out in the Nigerian stock market, and in any stock market, but I'm going to focus on the Nigerian stock market. The first thing you have to do is to set aside what you want to invest.
Okay.
So you don't want to invest everything that you have. You have, let's say 10,000 naira in savings. Then you could say, okay, let's do 50%. Let's do 60%. Some people could be aggressive to do 90%.
Do you advise someone to be aggressive from the beginning?
So from the beginning, you are just starting out. So why don't you do 50%? Do 50% and then keep 50% for emergencies. There is a rule, which is you keep 6 months emergency fund, which means some amount of money that can give you a 6-month runway.
Okay.
In the event that maybe something happens, you lose your job or something. So you have to set aside what you want to invest first. That's the first thing you have to do. The second thing is that you have to understand the risk of investment. The reality is that, like they would say, invest the amount you can afford to lose. And my bias in the stock market is actually risk management. Yes, that's my particular bias in the stock market. I do a lot of risk management programs. So guiding people on how to manage their risk. So I'm not going to, anything I'm going to say on this podcast would lean towards managing risk.
Okay.
So understand that what you are investing can literally go to zero. Okay. There are no guarantees in the stock market.
Okay.
Yeah, the bond market is different because that's why it's safer than the stock market. In the bond market, you are literally lending to the government, and typically the government will always pay.
Yeah.
But when it comes to the equity market, you are literally going into something that can literally go to zero. So you have to understand the risk first. And let me tell you something about understanding the risk. Down the line, it will help you.
Okay.
Because if you understand that this month, let's say that 5,000 can actually go to zero, you are not going to panic sell when the market goes down. The market goes up and down.
Okay.
So you're not going to panic sell. But if you don't understand the risk and you are told, for example, maybe someone on TikTok, which is one of the things we are going to disabuse to them, tells you, oh, this is the best thing since sliced bread. And then you YOLO into that stock. And then you see a 50% correction in that stock. So from your 5,000 naira, it now goes down to 2,500 naira. If you did not understand and take into cognizance the risk of investing, you might sell off at 2,500.
And then the market may actually go up again.
Not knowing that that is a correction, and markets move up and down. Markets are in cycles. So, but if you understand the risk, you'll understand that markets do go up and down. And something that is very closely related to this is identify your time horizon. Yes. So it is important that you have a good time horizon for your investment. Are you doing long-term investment?
Okay.
Are you doing short-term investment?
You have those knowledge.
It is very important. Like I gave an example in the last edition of the podcast. I said, if you're investing in the, whether in the stock market, whether in the crypto market, whichever market you choose to invest in, your idea of your time horizon would help you a lot in making gains in the market. Because, for example, if you invest in crypto, I always advise every of my clients, you invest in crypto, you have to give it a minimum of 5-year time horizon.
Okay.
Because the market, there is always this 4-year cycle to the crypto market. And so currently we are in the bear market.
Okay.
Yes. So if you don't have this time horizon, then you are going to sell yourself out at the lows. Now, but even if you buy at the top, historically, the crypto market, specifically Bitcoin, has always returned a positive value if over a 5-year period. Meaning that even if you bought the top, in 5 years you'll be out of the water. You will be above water. So you must have that time horizon for every investment that you do. These 3 things: number 1, setting out the investment amount; number 2, understanding the risk of investment associated with investment, especially in the stock or equity market; number 3, having a time horizon for your investment. Those 3 things are the first mental things that you must do.
So the first step is just knowledge.
The first step is just knowledge and that decision.
Okay.
The second thing is, now that you have decided this is what I'm going to do, the next thing is for you to choose a stockbroker. The Nigerian Exchange Group does not allow individual traders.
Okay.
You can only trade through a licensed stockbroker.
And they're listed on the
Yes, and so licensed stockbroker is who is a licensed. He must be registered with the Securities and Exchange Commission.
Okay.
With the Securities and Exchange Commission, such a person must be registered and must be accredited by the Nigerian Exchange Group.
Okay.
Before you can commit your money to such a person. Now, so you can walk through stockbrokers. Like we have a lot of them. I don't want to promote names here, though, but we have a bunch of them.
Okay.
But you just have to ensure that you look up stockbrokers that are registered with the CAC, that is the Nigerian Securities.
Information on their website.
You can find it on the CAC, SEC website, Securities and Exchange Commission's website. You must find that information and accredited by the Nigerian Exchange Group, so that's the only person that you can invest with.
Okay,
that's one. Then the other thing is you can also use a platform like Bamboo, like Trove.
And those are the stockbrokers.
No, those are platforms that are registered platforms. So, for example, what does a stockbroker do for you? He gets you your central securities clearing system. It gives you the central holding the number. That's like the digital certificate for your stock. These platforms also do the same thing. So you have to get either a licensed stockbroker or an investment platform.
Those platforms still act like your stockbroker.
Yes.
Yes. Okay. All right. Now let's assume that we've actually taken the first two steps you talked about. You've acquired knowledge. We've chosen a stockbroker. Now, what is the minimum amount of investment somebody can actually start with?
You can start with 1,000 naira. Nowadays, we have fractional shares. So fractional shares there are some companies that are listed for, for pennies on pennies, really.
Okay.
Less than a naira. We call those ones penny stocks. So those companies, you can invest in them. You can start with 1,000. I always advise investors or newbies, don't invest too much when you're starting.
Okay.
Start little. The reason why we say you should start little is that you can survive a disaster. If you put everything you have into the stock market, and then you of course you're a newbie, and then you're in your research, your research or your decision, your pick or picks were wrong, then you don't have a chance of doing it again. But if you set aside sometimes 20%, 10%, just to try, just to learn the process, then you can, if that goes wrong, then you can still do it again. One of the reasons why people are averse to investing is because two things. Number one, either they invested in a Ponzi scheme, and that Ponzi scheme, someone tells you 20% per month. If you had something that pays 20% per month, you will not know about it.
They won't tell you.
Nobody will tell you. So that is a Ponzi scheme. So if people invest in Ponzi schemes, and of course, like the inevitable end of Ponzi scheme is that it crashes. These people now begin to look at investing, anything called investing, as an evil thing.
Okay.
Because of the terrible sore test they had with the last one they did. So that's number one. Number two, people that even if they invested in the stock market, but they've YOLO'd into one asset, no form of diversification at all. And unfortunately, that asset goes down. And because they don't have the emotional intelligence or the emotional discipline to look at the stock market, or maybe to rotate out to something profitable. Let's say you invested in a company. Let me give you an example. You invested in a company that is doing something that something else has replaced it completely, that the demand for that company's product or services is going down. Obviously, when the demand is going down, when profit is going down, investors will do what? Exit that particular position. So let's say you bought into the hype when that industry or that particular company was doing well. You bought into the hype. You don't understand how to be disciplined. You don't understand anything about patience in the market. Then, by the time you see the stock going down very sharply, sometimes because you have not done research, you don't know that this stock is actually on its way down because the demand for its product is no longer there. And you hold it until it gets to zero. That's where the mistake that you could make. So that's what I'm saying. As a starter, you must invest an amount that if it goes to zero, you can have some more dry powder to go the investment route again.
Okay, now I wanted to ask you to identify the mistakes common beginners actually make. You've actually done that. Now let's move to the next one. Let's see how we can group the stock market into the different groups, the different types of stocks, so people can know what to buy and tell us the risks that are involved in each of them.
Okay, so there are different types of investing. There are different portfolios you could create. We have what we call value investing.
Okay.
Value investing is where you look at the valuation of the company. Here you'll be talking about things like price to earnings ratio, things like valuation, things like disconnection or dislocation. So, for example, if a stock that has some very great fundamentals is valued poorly, sometimes markets do that. Markets do undervalue assets a number of times. So, smart investors, or maybe someone that is coming to invest, if you do your research very well, if the value of an asset, if the fundamentals of an asset has not changed, but the market is pricing it wrongly, you can buy it because you know that by the time the market realizes the value, then
Shoot.
let me give you an example. There is nothing that has happened to the value of Bitcoin since October, the 6th of October.
Oh, that's it.
That was last year when Bitcoin did an all-time high.
Yeah.
Nothing has changed in the valuation of Bitcoin. But guess what? It is selling at half the price. So that is where value investing, meaning that Bitcoin is highly undervalued. This is not investment advice, actually. It's not investment advice. But Bitcoin is, there's only 21 million Bitcoin that can never exist. That is scarcity. In the hardest scarcity known to mankind. So that is a typical case of something being highly undervalued. In funds are coming into the crypto space, buying Bitcoin. ETFs are buying. Treasury companies are buying. That is an insanely strong demand, but the price is going down. There are a lot of things that happened October 10th, dislocations and all of those things, very serious liquidation events. Those things contribute to the valuing of Bitcoin. So I'm giving you an example of value investing where you could look at an asset that you know that this asset is, nothing has changed in its fundamental, but the price has gone down. That for me is a discount. Smart investors look at that as a discount, like an asset is going on sale. That's number one. That's value investing. So you invest in a company with strong fundamentals, but whose fundamentals don't reflect in the price. You invest in those companies, and then by the time the market realizes the value of these businesses, of these companies, then you stand to make a lot of gain. Number two, we have what we call growth investing. So you look at companies that are moving very, very fast. Yes, companies that are moving very fast. Growth stocks are not don't lean so much towards towards rewarding their investors in the short term, for example, in terms of dividends and all of that. They are focused on reinvesting to grow the value of the company, to grow demand, to grow profitability, and all of that. That's a growth stock. You can actually invest in growth stocks.
You require a lot of patience.
And it requires patience because patience and your understanding of compound interest. Because why I'm saying this is most growth stocks focus on long-term value, not on payouts. So if you have a long-term horizon and then you have enough liquidity to keep yourself afloat, then growth stocks are for you. Then we have income investing. Income investing has to do with investing in assets or companies or businesses that pay dividends. You look at the likes of, Johnson & Johnson, Coca-Cola. There are a number of them. Even in Nigeria, we have banks. Many banks pay dividends and all of that. So if you're looking at income investing, some people, you can also invest in things like bonds, that also pays yearly. You have something that comes in. So that's income investing. That works for people that are maybe in the retirement age, or people that want something to be giving them monthly cash flow or quarterly cash flow for them to maintain their lifestyle.
Okay.
So what do we say is there is no one cap fits all. I cannot tell you go for growth stocks. Cannot tell you go for income investment or value investment. It depends on what your goals are and your priorities are. If you have some good runway, you can maintain your lifestyle with your current cash flow, you can go for growth, because growth, the value of your holding, your net worth, because we compare what you have as a matter of what is the value of this holding of that company that you have. Growth companies are more likely going to push higher than dividend stocks, because dividend stocks have to pay out to their investors, so there is little to really invest. But growth stocks focus more on reinvesting profits to be able to grow the business. So if you want to run a diversified portfolio, you could also look at combining them. Could have something from value, can have something from growth.
That's the best.
Could have something
investment.
from. But you can't say it's the best form because it depends on who. For me, if I'm a guy that is earning very well, I'm looking at growing my net worth rather than growing cash flow. And it's not. I might not go for the combination. But for beginners, yeah. So that's
spread. You can spread.
Beginners. Some beginners might want to do dividends because they want something to come in.
Okay.
Maybe they put in like 80% of their income in their savings.
They want every month.
They want something to come in every quarter. So that is exactly why you cannot really say this is the best. It's you just combine. The reason why you want to combine is in case anything happens.
Okay.
You put them together. Diversification has always been the best growth strategy and, of course, risk management strategy.
Now, two words actually confuse people in the market. First is trading, and another one is investing. Now, what's the difference between trading and actually investing?
Okay, trading is where you buy and sell in a short term. Short term. For example, you go to the market, you see the price of an asset, then you buy it. Within that day, most especially, maybe the price goes up, then you sell, or the price goes down. If you're in a short position, the price goes down, you sell. But when it has to be investing is something you do over a period of time. Let's say 1 year, 2 years, 5 years, 10 years, 20 years.
Okay.
So yeah, so one is short term, the other one is.
Now let's give the safest strategy for a first timer in the Nigerian stock market. The safest strategy. Like I said,
what you consider safest is dependent on who is investing. Safe, I mean, if you talk about the word safe, I mean, the only thing I can tell you, okay, you can have some guarantee, is investing in bonds. As far as you are in the equity market, anything can happen. But to be safe as a starter, you want to diversify as much as possible. It is nearly impossible except you have an economic depression, a great depression like the likes we had in 1929, in 2008 and all of that. A massive recession. Except that happens, that's what we could call a black swan event. Otherwise, it is almost impossible, or it is very rare for all the stocks in the market to go down at the same time.
So you have to diversify.
So diversification is the best way of managing risk and avoiding emotional investing. Because if a stock, I have one of my mentees who actually, first of all, he started by investing. He heard about a particular stock. He did not come to me to tell me, what do you think? He just told me to say, how do I invest in this stock? I don't want to mention the name. How do I invest in this stock? And he had about a reasonable amount of money. So I told him, stock or stocks? He said, in this particular stock. Every attempt by me to convince him to diversify fell on deaf ears. Apparently, he was already convinced. Maybe he was convinced, or maybe he was trying to brag to someone that, I am a shareholder in this particular company. So he went all into the company, to that particular stock. That stock corrected by 73%. He lost his mind. Completely, he lost his mind. And there's something I want to also mention for investors. Don't say, let's say you invested 20 million and then the market corrects by 50%. You lost 10%. That is paper loss. It's not realized. It's called unrealized loss. Because I know some people that say, if I had taken that 10 million to buy a car, I would have. Once you invest in the market, that money is an invested money. It's not your money anymore. It's the reality. One of the things that drives people to make emotional decisions in the market is when they think, this has corrected by 30%. What are the chances that it will correct maybe another 20 or 30%? So let me pull it out and wait until that next leg of 30% leg comes in. Then I get into the market. That's you timing the market. No, you don't do that. Rather, if you are investing, you invest knowing that it can go down.
Okay.
But if you diversify, When one stock goes down, guess what happens? Another stock could go up, so it balances the portfolio.
It's a flow of money.
So
money
it
moves around.
It moves around.
Money moves around.
You know, so when I called, and that's why you invest across industries. For example, let me use the US stock market, and there's a reason why. Donald Trump came in and he talks about drill baby drills. So he's pushing so much for fossil fuels. Anything that has to do with renewables will not work under this administration. So imagine if you put all your eggs into a renewable basket.
That's gone.
You are going to be very much underwater at this time. So, but if you put in renewables, fossil fuels, I mean, I'm talking about the energy sector now. Now, Donald Trump you can see what is happening to the oil price. You can see what is happening to oil companies, the stock price of oil companies. They are beating almost every quarter because the administration favors that particular sector, part of the energy sector. So that's the advantage in diversifying. Even within an industry, you have to diversify. In the finance space, for example, we have banks, traditional banks, we have fintechs, we have insurance companies, we have different companies in the banking, in the financial space. So you don't want to YOLO all into the banking sector because the banks posted so much gains last year. Okay, let me go in. No, you are going to be burnt very seriously. Rather, what you do is you diversify. Insurance, banks, fintechs, you name it. That's what you can do. Even in the telecom space, I mean, one of the calls we made just about a couple of months ago, you can see the performance now. MTN, it was one of our picks for this year, and you can see the massive.
We told them that's good.
They see the massive gain. So there are some things that you look at.
I even regret why didn't they buy since last week.
So the point is, I mean, while we don't try to make recommendations, as in we are not giving any guarantees, but sometimes based on the investment, the research that we are doing, there are some things that come out very, very, very clearly. So you want to be diversified. You don't want to YOLO into an industry and then focus on one sector of that industry. You want to be properly diversified. When you are diversified as a beginner, the biggest win for you is diversification. No matter how emotionally invested you are. I remember when Champion Breweries was doing their recent offer. Everybody that called me said, I want to invest in Champion. I want to invest in Champion.
Was it because of the hype?
I don't know, maybe. But everybody said they want to invest in Champion. It becomes a very terrible thing if you, as a beginner, hears that and you say, no, always diversify. Even if it happens that Champion, a particular stock does like 3x, sometimes some people will say, let's say you had 100,000 naira to invest, and then you wanted to invest in a particular asset, and then that asset, and then based on the doctrine of diversification, you did maybe 50,000 in that asset and 50,000 elsewhere, and then that asset does 300%. I'm just giving you an example, and then you say, wow. I remember when I have been investing in Nvidia for some time. So in 2000, 3 years ago, Nvidia did 221% gain. So someone told me, how? Imagine if you have invested your entire portfolio in Nvidia, you would have been sitting on a mountain of money.
Sold your property and
invested. You would have sold your property, taken loans to invest. You would have made a ton of money. No. And a smart and experienced investor will not do that. Yes, there are what we call home runs. Those home runs help to improve the Sharpe ratio of your investment portfolio. But there is no advice, there's no reasonable advice that would tell you to YOLO in completely to this. That's one. Then the other thing is, before I end this particular part of it, is margin debt.
Okay.
Some people go to borrow to invest in the market. Yes, it will give you some leverage. For example, let's say I have 100,000 and I borrow another 100,000. That makes it 200,000. And a 200,000 naira exposure into the market will give me way more. So let's say I say, oh, the NGX did so and so. Let's say it did 40%, 50% last year. And there's a place I can actually borrow at 20%. Okay. So if I borrow, which by the way ties into a particular principle that I'm going to talk about, the buy, borrow, die strategy. But for now, do you know I can actually invest and then do, if it does 50%, watch this. If it does 50%, then I would just, I can enjoy the 30% arbitrage. Can just repay the loan and keep the 30%. If. What if it doesn't? So as a beginner, I advise against margin debt. Borrowing to invest in the market. I advise against that. Experienced investors can do that, because experienced investors, sometimes you would borrow at 20-30%. But an experienced investor that has assets, what we call asset-backed loans, you can get it for as low as 10% or even less. Sometimes 9%, 8%.
Yeah.
If the market does just maybe about 12%, you still have something to go home with. Yeah. So I advise against borrowing to invest in the market for beginners. Start with the money. Remember, I said the amount of money you can afford to lose. So start with that. With what you have.
And just grow.
And then grow. Grow. Buy assets. Buy stocks. You can invest in real estate. As you are buying this, you are accumulating assets. When you accumulate assets, you could then use this asset in the buy, borrow, die strategy. You use this asset as loan, as collateral for a loan. Let us say you have maybe 10 million in assets, 10 million naira in assets. Instead of having to sell your assets to be able to fund your lifestyle, what you do is you can borrow against that asset, and because it's asset-backed loan, it will come very cheap. You can use part of the loan that you've taken to invest in the market. This is not for newbies. It's for people that have, as you have gained some level of understanding of the market. From there, you take part of it, fund your lifestyle, take part of it, buy more income-generating assets. That is the buy and the borrow strategy. In some other clients, like in the US, there's something interesting that happens. If I bought an asset for 1 million naira, and then in my years of existence, let's say I bought a house, let's say like 10 years ago, for 1 million naira. In my years, my life, throughout my life, that house now cost, let's say about 50 million. The day I die, I'm supposed to pay 49 million. Let's say I've been borrowing against that property. Instead of selling that property, that would trigger a tax event, because once you sell, that's a realized profit. So you are going to be taxed. Rather, you keep on borrowing against. Loans are not taxable. Good. So I keep on borrowing against it over and over again. By the time I die, in some climes, like I'm going to use the US, Nigeria really doesn't do that though. No. But in the US, the day you die, there is something we call a step up in basis. Yeah. The value, the cost base of that asset will no longer be 1 million. But it will be the cost of that asset, or the price of that asset at your death. Meaning that if your heirs sell that asset immediately at your death, they will pay no capital gains tax. Then
you're practicable in Nigerian stock.
It is not, unfortunately, it's not practical. But I believe that over time, because Nigeria is also it's an emerging market, but over time that allows for, you might think it's cheating. It's not cheating actually, but it allows for people to continue to remain invested. Okay. So what happens that if your children come around and they decide not to sell, and then throughout their lifestyle, that property from that 50 million now grows to 200 million. And then at their death, what happens? The step-up basis happens. That's why you see sometimes the very wealthy people pay very ridiculous amount in taxes in terms of the percentage of their net worth. Very ridiculous amount, because they understand all these tax strategies. So as an investor starting out, It's good that you understand these things so that you know that you don't just sell your assets, or do not just sell, oh, I invested 100,000. I see some people that come to me and say, I want to sell it in 1 year. No. If you invest in an asset, that a business that is it's a long-term business, then you can afford to, you keep on borrowing against it. So you allow compound interest, which by the way is the eighth wonder of the world, according to Albert Einstein, to work in on that property. So the asset that you bought for a little amount can continue to grow to a very impressive amount over time without triggering any tax event. That's the outlook that investors should have.
Okay. Now, let's group the stocks into the different form. Banking stocks and the rest of them. Let's group the stocks. And let's see you can actually branch into blue chip stocks. Let's see the difference. People can actually understand which area they should actually begin investment from.
So, for example, we have the financials. You have banks. I mean, Zenith, First Bank, Access Bank. We have, within financials, we have banks. We also have insurance companies. We also have like IGI, Industrial General Insurance. You also have fintechs.
Okay.
Fintechs.
There are companies under
fintech that provide fintech services. Now, but while you are looking at this particular area, you have to understand that fintechs have a growth potential because of most fintechs do not need physical presence to really expand. They are technology-enabled financial operators that don't need such capital, a huge capital outlet. That's why they are growing in leaps. Then you also have industrials, companies that manufacture. You have like the Dangote Group. You have like the Boa Cement. You can name it. Those are industrials. So you can choose to go into industrials. And I think at this point, industrials are really making it. Because if you look at like Dangote Cement really led the rally a couple of weeks ago. You know why? Because the cost of housing now is through the roof. Mm-hmm. Yes. Everybody's going to real estate now. But again, like I always say, when people are talking about it too much, you might be towards the top. Yeah. So you don't want to. That's why I said, if there's something you don't want to do, don't follow the hype. Which I had talked about value investing. Look at something that is strong fundamentals but is being undervalued. Good. Then the other one would be things like consumables. Like, Guinness did a very good job last year. So you might consider some of those brands. Even the Nigerian breweries itself is also there. Well. They did very well. Then you look at the likes of telecoms.
MTN.
Telecoms is MTN did a very good job. But there are other emerging companies that are coming in to the market. The growth companies. We are talking to investors, and then we also let me say this, because our investors are not people that have just 1,000 naira. If you have a decent amount of money, there is an area that is often very largely ignored, which, by the way, has some of the biggest potential. That is in private credit, the private sector, private investing. Some companies, if you ask me, by the time a company comes to list publicly, the alpha is gone. I happen to work with a company called Transistor Alpha. So we really look at the alpha. So that is where private credit comes in. That's where you want to invest sometimes in the private markets. Many people that talk about investing, they completely ignore the private market. The private market is a little bit more risky because companies are not obliged to publish their earnings and all of that. So, but these companies, remember, they are privately held companies. So at that point, the alpha is still there. So if you have the only thing with companies like that is the barrier to entry. You cannot do that 1,000 I told you cannot work with this. So some of these companies do funding rounds. You have pre-seed, you have seed rounds, Series A, Series B, Series C, Series D, Series E. Within the private market, you can get into this funding round after doing thorough research. For example, if you see the way AI companies in Nigeria, AI companies are moving very fast. I happen to be an investor in one of them. That company has been around for just about, is it 5 months?
Is still the AI bubble that has been brought to this place?
Maybe I refuse to use the word bubble though. But this company has simplified some of the core business processes. The company does sales automation.
Wow.
Yes, sales automation. The company does.
A Nigerian company.
Yes, it's a Nigerian company. The company does customer service, AI powered customer service, voice, AI voice. They do quite a lot of such service, such that if you have a business, you don't really need to hire customer service representatives. So you sign up on their platform, then they train their AI on your company's data, the knowledge base of the company, the resolved tickets. So by the time someone calls in, the company, the AI tool can actually work. So now that company, I think within that 5 months, the value of that company has done more than 20x.
Wow.
Yes. So the private market is where people ignore the most.
There's a lot of profit.
But there's a lot of alpha in those markets. But again, you need to research so much because in those markets, some of them are not really registered. They are not under the purview of the SEC. The SEC is like what I can call the referee, the umpire, ensuring that the rules that people do well in the market. The disadvantage of being in the private market is that you don't have such clarity. Good. So, but I mean, it's like they say risk to reward. Like I said, you don't put all your eggs in one basket. In fact, as a venture capitalist, the way we do it is we invest across 10 companies. We believe that 8 of them will fail. We already have in mind that 8 of them will fail. Or even 9 of them will fail. We just need one to be successful, to be a home run. And then we'll compensate for all the others that have failed and even give us the alpha we're looking for. So that is private market. Private market is an area that people really don't think about, but it has a lot of alpha.
All right. I think we'll continue this conversation again. And I would like us to dwell on what Dangote says about the Dangote refinery. We want to list it in the Nigerian stock market so that Nigerians can start buying stocks from it. So we're going to do a thorough analysis of it in our next episode. Let's see the pros and cons of actually investing in the Dangote refinery. But before we go, I'd like you to actually give your final words to our beginners.
My final word is, as a beginner, please consider risk management. If you don't make money, don't lose money. Please, as a beginner, have a reasonable time frame for investment. Please, as a beginner, do not invest everything. Have a certain amount that you want to invest. Psychology is the biggest part of investing. No matter how much the technicals take, no matter how much the research takes, if your investment psychology is poor, you are 100% guaranteed to lose money in the market. The market, especially the stock market, is a risky environment. So you have to hold, like your breastplate should be risk management.
And if you want to actually reduce that risk, you can actually like, subscribe, and follow this channel because we do a thorough, detailed analysis of every company. I think we should end it here.
Thank you very much.
On that note, to come to the end of today's episode of Clockwise. Please do not forget to like, subscribe, and put a notification bell on this channel because we do thorough analysis here every week. And also do not forget that the illiterate of the 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. My name is Providence, and I was with Mr. Kenneth. See you again next week.
Thank you.